Gold prices have shot up to another record high. The reason for this massive jump has been the non-farm payrolls data as well as the unemployment rates. Later on in this video, I'll explain why that caused gold to surge, but for now, in this video, I'm going to explain what the non-farm payrolls are, otherwise known as NFP, as well as what the unemployment rate is and what that means for the economy. These two reports are usually released together. Think about it, payrolls and then employment, they go together. These sets of numbers that are released have a massive impact on the economy. They can jolt the US dollar, they can affect interest rates, stocks, and of course, gold. Often, as you've seen just then, in a matter of minutes, it shoots up. However, it's not just about how many jobs were added. It's about the unemployment rate, wages, revisions, and crucially, the most important thing to understand is how the forecasts compare to actual results. That's where the money is made, not financial advice. Let's get into this and break it down to see how professionals read it and understand it and why it matters globally. So first off, what is the non-farm payrolls? The non-farm payrolls is a monthly change in the number of payroll jobs. It's published by the United States Bureau of Labor Statistics. It covers most industries, but excludes farms. Non-farm payrolls excludes farms. I know you're learning a lot on this channel, but it also excludes other industries too, such as private household employees, self-employed people, and the military. And off the top of my head, while recording this, I'm pretty sure it excludes things like NASA and the CIA, but I'm not 100% sure on that. But anyway, importantly, at the same time as this release, we also get the unemployment rate, as well as the participation rate from a different survey of households. This explains why sometimes the job numbers and unemployment rate tell slightly different stories, because they're based on two different surveys. So why do markets care and what do professionals look at first? When the report first lands, as it's just done, and we'll get into that soon, traders typically scan 5 lines almost instantly. This is news trading. First, they look at the headline non-farm payrolls, basically the jobs added or lost. Then they look at the employment rate, the share of people looking for work who can't find it. Then they look at the average hourly earnings. They look at wage growth. This is important because it feeds directly into inflation pressure. And of course, inflation can affect what the Fed does, and therefore what the Fed does affects the economy, and what the economy does affects gold. But I'm digressing again. Traders also look at average weekly hours, which is an early demand signal. And finally, they look at revisions to previous months, which can completely change the story. So why does all this matter? See, strong jobs and rising wages suggest the economy is running hot. Therefore, inflation might stay high, and therefore interest rates could stay high for longer, which in turn lifts the US dollar, and therefore bond yields, which in turn can pull gold down. However, weak jobs and soft wages can suggest the economy is cooling. Therefore, interest rates may not need to stay high, which in turn means the US dollar can fall. As you might know from the channel, when the US dollar falls, gold prices often do very well. Let's talk about the forecast versus the actual results. What really moves the markets isn't just the number itself, but how it compares to the forecast. This is what I was touching on earlier in the video. Say it's a big beat. Say jobs and wages are much higher than expected. Then the markets will suddenly price in tighter policy, which in theory raises the US dollar up, therefore interest rates up, and therefore gold usually drops. However, if it's a big miss, such as it was just recently, the jobs are weaker, unemployment's higher, and wages are softer, the markets then see a lower rate risk, which brings the US dollar down, therefore interest rates down, and therefore, good for gold, it rises. But say, what if it's mixed? What if it's not certain one way or the other? Say, for example, strong jobs but mixed wages, or the other way around. Well, in that case, you're going to have messy reactions. And that's when revisions and weekly hours help sort out the picture. I hope all this is making sense. I'm trying my best to explain this in a clear way. I should probably make graphics to explain this, but... So how does gold fit into all of this? Well, as you know, gold doesn't pay interest, so therefore it competes with assets that do pay interest, such as government bonds or shares. That means that gold is sensitive to real interest rates. What I mean by real interest rates is interest rates adjusted for inflation. And of course, gold is also sensitive to the US dollar. So if non-farm payrolls are strong and push both yields and the dollar higher, gold usually weakens, at least temporarily. Depends on many other factors too, of course. However, if non-farm payrolls are weak and bring yields and the dollar down, this usually strengthens gold. So I hope you can see how this works. And this is why professional traders shouldn't ignore the jobs report. Although all the videos on YouTube that trade, they don't talk about news trading. In fact, I've seen a lot of these videos, they say, I don't trade around the news. I'm like, you're trading blind if you don't know what's going on in the news. But a lot of these channels get a crazy amount of views, but they promote using indicators and don't understand the macroeconomics. And that's probably why most people lose money in trading. However, if you subscribe to this channel, you'll learn a lot about what's going on, and therefore, most likely, do better in trading, but not financial advice. And I could be wrong, so don't, I could be wrong. This is just my opinion. So let's talk about the unemployment rate and labor participation. The unemployment rate is defined as unemployed people divided by the total labor force. So it comes out in a percentage. But don't just take it at face value. If the unemployment rate falls because people stop looking for work, that isn't genuine strength. That's why, importantly, the participation rate, which is the percentage of the population actively working or seeking work. So understand the participation rate is also quite important. So in July 2025, the United States added around 73,000 jobs, and the unemployment rate was 4.2%. Those numbers were weaker than earlier in the year. So the most recent non-farm payrolls and unemployment rates that just came in were much softer than expected. About 22,000 jobs were added in August. This is well below the 75,000 jobs the economists had predicted. Unemployment ticked up to 4.3%, which matched expectations. Therefore, the US dollar weakened and treasury yields dropped right after the data was released. And gold absolutely surged. I was tempted to record it real time on my chart just to make this video better, but I didn't do that for some reason. But anyway, I might do that in another video. News trading is quite exciting, by the way. I don't know why other traders are so... Every trader on YouTube is absolutely terrified of news trading. You just have to know what you're doing and manage your risk. Not financial advice, though. So anyway, the reasons why gold surged to an all-time high is because there was weak job growth, as just discussed, and also rising unemployment. So this sent a clear signal that the economy is cooling. This has pushed markets to expect an imminent interest rate cut by the Federal Reserve, making gold much more appealing. As I've said before, gold doesn't earn interest. So when yields fall, I think I'll just keep repeating this because it's really important. When yields fall, gold suddenly looks more attractive. I know gold always looks attractive, but it looks even more attractive. And it looks more attractive compared to bonds. And this is often on a very institutional level, I want to add, because if you're a retail trader or a retail investor, you're probably not, depending on your portfolio size, you're not buying a crazy amount of government bonds, depending on your account size and if you're retiring or not. Of course, not financial advice. I'm just giving broad statements here and my opinions. On top of all this, add in the underlying geopolitical uncertainty, which I talked about in my last video, the surging safe haven demand, and central banks buying gold over treasuries. That's important, by the way. And the rally around further lift, gold has done very, very well, which wasn't a surprise for me, but that's why you should subscribe to this channel, because I'll keep you up to date. And I'll explain everything that other traders don't even bother explaining. How many trading channels have you seen explain what the non-farm payrolls even is? They just say, oh, put on this indicator. It's like, why? Do you think Bitcoin and gold trade the same? Do you think the S&P 500 trades the same as Euro USD? I mean, come on. Like, people pay courses. People pay a lot of money for these courses, and it's like they teach indicators. It's ridiculous. I mean, indicators are fine if you're using them with something else, but the only reason I think indicators are useful is because the market knows the market is using them. So I use them from the perspective of like, oh, if it hits a 200 moving day average, the market knows it's going to hit the 200-day moving average. That's kind of, and also with support and resistance as well, because historically it's moved at that price and the market knows this. But I'm getting more complicated again. But anyway, if you want to trade the non-farm payrolls or the unemployment rate next time, I'm going to give you a checklist right now you can do. So obviously know the clock, know the time zones you're in and what time it's being released. So I'm in Australia, so it was released at 10:30 p.m. Australian time. Make sure, as soon as it comes out, make sure you scan the top 3: jobs, unemployment, and wages. Check revisions, because these revisions often change the whole picture. Map the surprise to the assets. So for example, a strong US dollar, therefore gold weaker, or a weak US dollar and then rates are down, therefore stronger gold, which I've talked about this many, many times. And also keep perspective, because one report doesn't set the whole cycle. Usually it sort of confirms in with other things. It's like a big puzzle with this macroeconomic stuff. It's a huge puzzle. That's why I recommend subscribing to this channel, because I'll explain it all over time. I've got a little playlist of gold price education. And importantly, make sure you cross-check all this with inflation data and central bank guidance. Do not just rely on indicators like everyone on YouTube seems to be doing. Thank you for watching. Please subscribe and see you next time.